Hi everyone, welcome to this workshop on magnetic capital. I'm your host Victor Menasce, author of The Great Canadian Takeover, managing partner at U.S. Real Estate Partners, and president of the Auto Real Estate Investors Organization. Very excited about what we're going to talk about today. It's all about raising capital for whatever projects that you are working on, whether it be real estate, a startup company, buying a business. It doesn't matter. The process, the principles of raising capital are pretty much the same. Okay, so let's go through the agenda here, what we'll cover today. We're really going to cover 5 things. Number 1, what are some of the principal obstacles to raising capital for most people that are new to this? We'll do a quick financial literacy test. Then we'll cover the 5 key principles of raising capital, and this is really what I practice on a daily basis. Talk about how to learn more, and then we'll wrap up with the homework and any questions you may have at the very end. So what gets in the way for most people when it comes to raising capital? Raising capital is not one of those things that you can, go to Algonquin College for, or virtually any university, and find a course on it. There's very little that's out there in the public domain on that topic. I think there's a number of reasons for that. The people that are good at it consider that to be part of their secret sauce, and so they don't really want to necessarily share that. Because of that, there is a general lack of knowledge. And with that lack of knowledge also comes all of the other obstacles that are inherent with that. In order to get good at anything, you have to practice at it. So if you don't have the knowledge, it's very hard to get through many different iterations of practicing your craft and getting good at it. For many people, fear is an enormous obstacle. There's a tremendous fear of asking for money. And I have to tell you that is a very real fear. It is a complex legal environment. The environment varies from state to state, from province to province, as well as from country to country. And so there is an awful lot to learn to make sure that you're doing it correctly. It's particularly important in the United States, where failure to follow the Securities and Exchange Commission rules subjects you not only to civil liability, but also criminal liability. So if you don't follow the SEC rules, you can land up in jail. There's really very few places to learn, and mentors are hard to find. So against that backdrop, that's one of the reasons why it's very difficult for people to get good at this. You're lucky because I'm willing to share this with you, and I've been doing this for a number of years. I've done 5 mergers and acquisition deals of different companies. I raise capital on a daily basis for projects around North America. I've raised over $300 million in my career, and it's something that I may not be the world's greatest expert at it, but I'm not a rookie at it either, and it's something that I do on a daily basis. So hopefully you can benefit from my experience. Okay, so one of the most important things when it comes to practicing as a real estate investor or as a business person is to have a high degree of financial literacy. If you're going to be raising capital, the people that are going to be giving you money have a high degree of financial literacy, and they expect the same thing from you. If they don't view you as being at their level, they can be very reluctant to lend you money or invest with you. So it really is a prerequisite of playing the game. If you're not an expert at this, if you're not 100% comfortable, then all I can tell you is get over it. You need to get good at it. The financial scorecard, you're very familiar with the report card that you used when you were in grade school and in university. In the business world, we use a different scorecard. We use a different report card. And it really comes down to the income statement and the balance sheet. If you don't have your own personal income statement and balance sheet, and if you're not managing yourself and managing your businesses as a business, I would suggest you need to start doing that. I have personal financial statement up to date every 30 days because anytime I go to a lender, they're going to demand it. So I want to be able to turn that around on an hour's notice and be able to give them a personal financial statement that's inclusive of my own personal financial situation in all of the 22 companies that I have an ownership stake in. So I need to have that current at my fingertips literally on a monthly basis. And my accounting and bookkeeping staff work hard to make sure that that is kept current. I maintain my personal financial statement, and in addition to that, I also provide what's called a schedule of real estate holdings, where each individual, this is basically a spreadsheet where it lists all of the properties in my portfolio, the ownership, what percentage ownership I have in it, the debt against the property, the income, the monthly expenses, the net operating income, and so on. So it's really a complete financial snapshot of the portfolio in addition to the personal financial statement. It's called a Schedule D for many lenders, and so we use that to show essentially the real estate picture in addition to whatever other businesses I may have. So with that, I'd like to take you through a little financial literacy test. This isn't to embarrass anybody. It's just to get a sense for where you're at. This is a short test. It's only 5 questions, multiple choice. I have a longer test that's about 15 questions that we could do at a later time or perhaps in the 2-day workshop. But this will at least give you a sense as to whether this is something that you need to put a little bit more time and effort into. The first question is, which of the following does not appear on the income statement? And I'm hoping you can all see this. Is it A, rental income, B, the interest paid, C, property taxes, D, amortized loan payments, or E, interest earned? So just write down what you think the right answer is. Just write down the letter code, A, B, C, D, or E, and we'll move on to the next question. So which does not appear on the income statement? Next, the depreciation expense on an income property will cause on disposition A, a cumulative net investment loss, B, a tax loss for the year, C, a decrease in the adjusted cost base, or D, a reduction in tax owing. Okay, ready to move on to the next? The definition of accruals is A, matching assets to liabilities, B, matching revenues to assets, C, recognizing revenue and expense when they occur regardless when paid, D, accruing for revenues and expenses when they are paid, or E, accruing for revenues when they occur. So we're looking for the definition of what is an accrual. Next question. A company has more cash today when A, customers pay their bills sooner, B, accounts receivable increase, C, the profits increase, or D, retained earnings increase. So A, B, C, or D. And then the final question in our little literacy test. Mix of debt and equity in a firm is referred to as the firm's A, primary capital, B, capital composition, C, cost of capital, or D, capital structure. So hopefully you've written down your answers, and now we'll review the questions and see how you all made out. Okay, so the very first question was, which item does not appear on the income statement? Now the correct answer is amortized loan payments, because the income statement only covers income and expense, and the amortized loan payment contains both the interest expense as well as the principal paydown. And the principal paydown is a balance sheet item. It's not an income statement item. So the correct answer for the first question is D. The second question, the correct answer is C, a decrease in the adjusted cost base. So when you depreciate an income property, it's not an actual cash transaction. It's as if you ended up paying less for the property when you acquired it. That's the kind of the definition of depreciation. So it decreases the adjusted cost base, and when you dispose of the property, you will potentially end up with a larger capital gain because the cost base of acquisition has been reduced. So that was C. Next, the definition of an accrual is also C, recognizing revenue and expense when they occur, regardless when they are paid. So when the cash actually flows, that goes to cover two accounts that are called accounts payable and accounts receivable, and anything that doesn't get paid when it occurs gets accrued in one of those two accounts, either accounts payable or accounts receivable. So that was C. Next one. A company has more cash today when, the correct answer is D, when you have an increase in retained earnings. And then our final question, the mix of debt and equity in a firm is referred to as the company's capital structure. This is D again. So I don't want to call anybody out. I guess the first question is, did anybody get 100%? You did, Nick? Good for you. What I didn't either, sorry. Okay, that's fine. And it's not, if you haven't been schooled in this, it's not surprising you won't get 100%. These are a little bit tricky questions. But when you're dealing with sources of capital, they will expect you to be literate at this level and more. So if you didn't get 100%, I'm going to recommend for you as homework that you go find some additional material so that you can become literate on some of these basics. It could be as simple as taking a bookkeeping 101 course or something to that effect. There's lots of resources out there on the internet that I can suggest. It's important that you become financially literate in this way. I know it's a little bit dry, it may be a little bit boring, but it's just part of the table stakes to play in this world, is to be financially literate on stuff like this. Okay? So if you got less than 100%, I would suggest that you look at taking some additional course. Okay? Okay, if you've heard me speak before, you've heard me talk about the 5 F's of real estate investing. And the 5 F's are, you've got to find a deal, you've got to figure it, meaning run the numbers, you have to fund it, fix it, and either flip it or finance it. Now, the purpose of this little easy-to-remember model is, it serves a few purposes. Number one, it helps define who does what in the business. So when I look at my business, the first item goes to my staff. Running the numbers, analyzing it, and funding it is primarily my responsibility. And then the actual construction and the management of the construction and the ultimate sale or refinancing of the project is usually my staff responsibility. So it's very important when you look at the makeup of your team, the makeup of your investment business, that you have a complementary set of skills. And those skills have to be different enough that they are experts in each of the respective areas. It's very rare to find an individual who has sufficient skill that they're an expert in all of these areas. And even if they were an expert, I would challenge whether that even makes sense to try, because there just aren't enough hours in the day. The goal of this webinar and the goal of the upcoming 2-day workshop is to really make you an expert in number 2 and number 3, analyzing a project and getting it funded. We're not going to spend an awful lot of time on numbers 1, 4, and 5. Okay, so the 5 principles of magnetic capital. Why magnetic capital? If you have a compelling project, both financially and you have a compelling team, then money will be drawn to you. There's no question money will be drawn to you. But in order for that to happen, you need to obey these 5 fundamental principles. Relationship, trust, results. You've got to have some great deals, and you have to have alignment of goals between the goals for your project and the goals for the money. So I'm going to go into this in a little bit more detail. Let's talk first about relationship. People generally invest with people who they know. I know that I would have a very tough time parting with hundreds of thousands or millions of dollars to somebody that I didn't have an existing relationship with. And most people are like that as well. Unless they're a lender, a professional lender, and they put very high degree of legal safeguards in place so that they're protected even if they don't have a relationship with you. Most others will require that they have a relationship, a pre-existing relationship. So then the question is, what is the basis of that relationship? How well do you know the funding partner? People with money generally are very concerned about having genuine relationships. Nobody wants to be used. Nobody wants to have a relationship strictly for the purpose of some financial transaction. They want it to be more genuine. And the wealthier the individual, the more that's true. So one of the key elements for you on your journey as an expert in raising capital is to develop relationships with people who have substantial means, but those relationships have to be genuine. If people feel that you're interested in them only because they have money, it's going to take on a very utilitarian feel. They may do a deal with you or two, but it's not going to be a relationship that will stand the test of time. So you really need to focus first and foremost on building genuine relationships. And that means adding value to the individual rather than looking for the individual to do something for you. I'll give you, and now there are many different reasons for having relationships. There are many different things you can get from a relationship. And I say this from the perspective of someone looking to get something from a relationship. You get one of a few things. You get potentially advice and wisdom. You can get introductions to other people. You may get access to capital. You may get credibility. So a good example of that would be, I have a relationship with Donald Trump's attorney, Mr. George Ross. George has a lot of money. He's got $300 million of net worth. Now, he's never going to invest with me, and I would never ask. But I get a couple of things from him. I get amazing advice that is really second to none. And I also get a lot of credibility because when people know that, I'm hanging out with guys of that caliber, then that speaks well of me. So it brings me credibility. All right, I'm going to give you an example. So this is one of my funding partners. This is Tom. He's the gentleman on the right-hand side. The gentleman on the left is in fact Mr. George Ross. We were having lunch together at the Trump Tower a couple of months ago, Tom and myself and Tom's wife with George. Now, Tom has invested in multiple projects with me, both real estate projects and others. I think one of the reasons that he keeps coming back for more, and he's not alone, I have many repeat investors, is number one, we communicate very openly and transparently. There's a high degree of trust in me because he knows that I'm looking out for his interests. Tom has a fair degree of assets at his disposal. He owns 5 houses in Martha's Vineyard, in Hawaii, and all over the place. So he's a reasonably wealthy guy, and he wants to put his money to work. He's retired. He and his wife want to travel the world, and at this point, he just wants to put his money to work and derive cash flow and income from having done so. Today, I have 19 different funding partners that I work with. Tom is just one of them. He's one of the better ones, but I have, like I said, a large number. So what I'm sharing with you here is not just a one-off. It is something that has been repeated and tried and tested multiple times. The second element is trust. And trust has a lot of layers to it. There's an entire psychological contract of trust. And it's questions like, can I trust you with small commitments? Can I trust you to ask the right questions? Can I trust you to put together a good plan? Can I trust you to execute the plan? Can I trust you to communicate frequently and transparently, in particular if there's a problem? People who have a lot of wealth, they're not rookies at this. They know that there are going to be problems. They expect there to be problems. But how you behave in the presence of those problems will either build or destroy trust. Can I trust your systems? Can I trust you to hire the right people? Can I trust you with my money? Can I trust you when I'm not looking? And on and on and on and on. And if any one of those elements is missing, it actually doesn't work. So trust is foundational to raising capital. And when that trust exists, decisions to invest get made very quickly. When that trust does not exist, that's when you go into weeks and months of due diligence. So if you want to move quickly, if you want to be able to take advantage of stellar opportunities that exist in the marketplace, then establishing that deep level of trust with your funding partners is one of the best things you can do, not just for all of the wholesome reasons that you might imagine, but enables you to move faster than just about anybody else. Next, results. People want to know you have a track record. What have you done? Show me you know how to be successful. Who have you got on your team? Who are your advisors? People invest in businesses. And businesses, by definition, are a team sport. People generally don't invest in the self-employed. If you're looking to raise capital, in my opinion, you've got to have a team. If you're just trying to do this on your own, it's going to be extraordinarily difficult because the investor is going to feel like there's too much risk. What if you get sick? What if you go on vacation? Who's managing the business? Whereas if there is a going concern, if there is an established business with a bit of scale, then the business can survive if one individual is out of the office for a month. But if you're self-employed and you're out of the office for a month, then everything comes to a stop. Now, you might ask yourself, well, what can I do if I'm just starting and I don't have a track record? Well, this is not like being back in grade school, where if you work with somebody else, you're cheating. Again, this is a team sport. If you don't have the expertise on your own or within your team, then align yourself with someone who does and work together with them on a couple of their projects. And now you can start to borrow some of their credibility. You can start to borrow some of their track record because you've been part of it. And that's perfectly legitimate. Let's talk about what constitutes a great deal. So this is the fourth element. You've got to have great opportunities. And I'm going to give you a couple of examples here. And this isn't to be arrogant or brag or anything like that. I have a very specific way of thinking about what constitutes a great deal. And for me, it has a few characteristics. Number one, I want an opportunity where I can generate under my own control. I don't want to rely on the market. I want to be able to create value myself, meaning our business. I want our business to be able to create that value. I also want it to create enough value that I can have an interim exit, typically a refinance, and recoup 100% of the invested capital and be able to return capital to the investors in a very short time period. And when you do that, when you have that structure, then you have a very compelling argument because, in this particular case here, I've got a 10-unit apartment building that I'm showing on 25th Street in Philadelphia. An investor is not going to want to tie up their equity for the next 20 to 25 years. They rarely have the ability to see that far, and they know that if they put money in, once it's in, it's very difficult to get it out. But what I show them is I know how to get it out in 12 to 18 months. So this particular building, we purchased the land for $45,000. Our total construction is just about $1 million. We have an appraisal in hand for $2 million. So in approximately 12 months, we've generated $855,000 in equity. That's real value that we've created. And we can refinance that property at 70% loan to value, recoup $1.4 million out of the $2 million appraised, and return 100% of the invested capital. And still have a bit left over to go spend on another project. And when you refinance, that's a tax-free event. There's no capital gains, none of that. It's just a refinance. You've just borrowed money. This picture on the right-hand side was taken about a week ago. It was taken on the 11th of February. You can see the building's under construction. And it's going to be complete in about a couple of months' time. So this is one example of that. And this property will generate healthy cash flows with a strong debt coverage ratio, and it's in an area that's in increasingly very high demand. Second example, this is a property about a block away from the one I just showed you. We purchased the land for $19,000. The building that was there, you can see, was in terrible condition. We demolished it, and we put up a new fourplex, which you see here. This building, I would say, this picture is about a month old, but this building, I think, will actually start showing completed units sometime in the next week to 10 days. The kitchens are in, granite countertops are in, appliances are not yet, but the rest is pretty much done. So we got this Land for $19,000. We put $384,000 in construction. We have an appraisal in hand today for $560,000. So we've got $160,000 in equity, approximately. I'm probably going to get it reappraised. I expect something in the range of about $620,000. And again, we'll be able to recoup 100% of the invested capital, return that to the equity partners, and have a cash flowing property. You can do this on small projects. You can do it on big projects. I'll tell you about a big project. It wasn't mine, but I think it's important to copy what the big players do. There's a large private equity firm called Texas Pacific Group. They manage assets in the billions of dollars and tens of billions of dollars. They acquired, a bunch of years back, they acquired Hertz Rental Car, which was a public company, and they took Hertz private. They made a few changes internally. They improved the profitability of the company. They restructured some of the debt, and they did an initial public offering of the shares for Hertz. And when they did so, they floated 50% of the shares. So 50% of the shares were sold on the New York Stock Exchange, and the other 50% they kept for themselves. Well, they recovered 100% of the money they had invested to acquire Hertz in the initial public offering, and they still were left holding 50% of the company. And they did that in 18 months. That's a very strong deal. So the same formula applies regardless of whether you're doing a fourplex or whether you're buying Hertz Rental Car. The same formula applies. So I think it's very important to look at what the big guys do and emulate that. I'll give you another example. This is a project on Ingersoll Street where we did an entire land assembly. We acquired an entire city block. We've got 3 9-unit buildings for a total of 27 units. We purchased the land for $360,000. The value of the construction is about $3.5 million. We don't have an appraisal yet, but we expect it to appraise at about $5.3 million. In that project, this will be complete in about a year's time. We haven't broken ground on it yet. We expect to break ground in the next 60 days. We'll generate about $1.4 million in equity. Same deal. We're going to refinance at the end, return the capital. It's the same process. Doesn't matter what the size is. I've got a residential subdivision in North Carolina. This is a 90-acre project. It's actually 306 residential homes. The total value of the construction is about $65 million. The retail value of the project is about $92. I expect we'll make somewhere in the range of $17 to $18 million in net profit. The owners of the property have hired me and my team to run it. This is a significantly larger project. I'm not scared by its size because the process for raising the capital is exactly the same. It's the same as what it would be for the fourplex that I showed you. I'll show you one more. This is a project we're doing in Kentucky. We have 8 oil wells. We're actually in the middle of drilling the very first oil well. This is about a $1.8 million investment. We're expecting about 40 barrels per day per well. And even at today's deeply depressed oil prices in around $50 a barrel, we're expecting the project to be valued at about $16 million. I can refinance that $16 million at somewhere between 40 to 50% loan to value. I can repay the original $1.8 million investment and still have a lot of cash left over to go invest in other oil wells and have a very strongly cash flowing project. I hope you're getting the picture that the process, doesn't matter what the business, doesn't matter what the size is basically the same. And when you have projects like this, I don't have to go asking for money. I never do. All I do is I go to my funding partners and I offer them the opportunity to participate along with me. And if they view it as a compelling opportunity, and I hope that some of you view these as compelling opportunities, then raising the money is relatively easy. It's really quite easy. And the decisions get made fairly quickly. Now, obviously, things like oil wells, they require a certain degree of due diligence. And, we probably spent 75 days in due diligence and negotiating contracts and all of that kind of stuff. So we probably had about 80 or 90 pages of contracts to go through. But it doesn't matter. I'm willing to go through that level of effort for projects of this caliber. And I think most people would be. The last item. number 5, and that is alignment. Alignment is kind of like a pair of shoes. You may go to the shoe store, you may say, wow, that's an awesome pair of shoes. I would love to have them. But if they don't fit, it doesn't matter how lovely they are. It doesn't matter how good the deal is, how much they're on sale. If they don't fit, you're not going to buy them. And so it is with raising capital. There has to be a fit. Money always has an agenda. Money always has a model. So some equity partners have a particular way of, a particular style of project that they like to do. Certain lenders have rules that they follow. I've got a lender that I'm working with in New York City who has a minimum. He says, hey, you won't touch anything less than $10 million. It's not worth their time and effort to do the paperwork. So I'm careful. I don't bring him a deal that's less than $10 million. He'll probably end up funding that residential subdivision. Certain funding partners have rules that they need to follow in terms of security or terms of repayment or the length of time for the investment. Some, banks like to put money to work and forget about it. They'll put money out there for 5 or 10 years. Other investors, they want to recycle their capital on a shorter time scale. So you need to pay very close attention to what are the criteria for the funding partner or the funding source that you're working with, and make sure that what you're proposing to them fits their model. Otherwise, it's not going to work. It doesn't mean that you've got a bad deal. It doesn't mean anything like that. But if it doesn't fit, it won't work. So those are the 5 fundamentals. I've been at this business for about 5 years now.
I'd like to introduce you
for a moment to my parents. That's my dad on the left, who was a dentist. My mom on the right was the second woman in history to graduate in architecture from Cornell University. They lived in Manhattan for 25 years and decided that New York City was not a good place to raise a family, so we moved to Canada. My mom designed many landmark buildings, including the building you see on the right-hand side there. That's originally the Pan Am building and now renamed the MetLife building. It sits on top of Grand Central Station. My mother was also self-taught as a civil engineer, and she designed the mechanical damping to isolate the Pan Am building from the vibration of the trains from Grand Central Station directly beneath it. Why am I telling you this? A lot of people look at me and say, Victor, you have been only at this 5 years. You've accomplished a tremendous amount. It almost looks like you're an overnight success. To which I say, I'm actually not. I'm actually probably 25 years in the making to be an overnight success. So if 25 years or 30 years is an overnight success, well, then I'm an overnight success. I had the misfortune of my mother passed away the day before my 19th birthday. Because of that, I got thrust into the role of having to learn and manage our family's investment holding company at the age of 19. Wasn't something that I particularly was looking for. It just happened. And so at the age of 19, our family attorney was teaching me how to write corporate resolutions, how to write dividend declarations, and all of that kind of stuff. So I got thrown in the deep end to start learning how to manage investments at that early age. If I had the chance to do it over again, I would have much rather had my mom see me graduate from university. I'd much rather have had her see my kids being born and so on. But that simply wasn't my fate, unfortunately. But I did manage over time to learn some of these principles, and it took a long time. It took a very, very long time. The good news is that if you have people actively teaching you and you're placing some focus on this, you can learn it a whole lot faster than 25 to 30 years. This wasn't my focus over the last 25, 30 years. I spent 25 years in the high-tech industry. So I learned this in little bits and pieces spread out over a long time. But with some focus, this is something that you can, in fact, accelerate and learn much more quickly. Now, I know many of you on the webinar have signed up for the workshop that is scheduled on February 28th and March the 1st. And for some reason, this slide is not advancing. Okay, so the Magnetic Capital Intensive Workshop, it's on the 28th of February, March the 1st here in Ottawa. We're going to be holding a couple of events outside Ottawa as well. We've got a Toronto date and we have an Austin, Texas date. Toronto is going to be April 25th and 26th, in Austin on June 6th and 7th. For those of you who haven't registered or are interested in potentially learning more, I would definitely encourage you to look at either a couple of the seats that remain in the Ottawa workshop or one of the other dates in either Toronto or Austin. This is a little bit of an eye chart. I'm not going to read through all of this. You're going to learn a ton of stuff. You're going to learn basically what it is that we do within my business on a daily basis. It's how to raise capital, how to do it legally, how to do it well, how to do it scalably and repeatably, how to structure the deals, how to obey the laws in the different jurisdictions as they may apply to you, how to get those 5 fundamentals that I talked about in the first part of the webinar, how to make those all fit. If any one of them is missing, it's not going to work. So you got to have all 5 of those. And so that's what I'm going to be teaching in this workshop. You're going to get a number of deliverables. You're going to get some project pitch documents. You're going to get some sample reports that we use to share with our funding partners, examples of some of our processes and systems that we use to manage projects remotely. Most of the projects I work on are not in my home city. So in order to do that and do it effectively requires a system. You'll get access to some of our project management templates, some of our financing structures, access to some of our lenders where it makes sense, and so on. And we'll actually give you some of our example legal agreements. Again, we're not in the business of providing legal advice that you've got to do on your own, but it can be tremendously helpful. I mean, we've invested tens of thousands of dollars in developing and refining these legal agreements. And so if you use something like that as a starting point to draft what it is that you want to accomplish and hand that over to your lawyer for review and modification, that can save you literally tens of thousands of dollars. We've got 2 levels of admission. We have general admission and VIP. If you elect the VIP, in addition to everything we just talked about, you also get preferred seating. You get some additional dedicated one-on-one coaching session with me. You get you get 2 copies of my book. You get, soft copies of the exact legal agreements that our team uses. You get copies of the partnership and operating agreements that our teams use. We'll sit down with you and review a couple of your deals. I also have another course that I teach on risk management, and so we'll give you access to that risk management course in webinar form. I used to teach a 2-day course on risk management. This is a condensed version of that, but it's an extremely important part of managing any project or any business. And finally, you'll get 3 months of direct email access to me via dedicated email address. So I think there's an awful lot of value in coming on as a VIP, but I'll leave that up to you. If you decide down the road, if we decide to work with you on a project, we'll actually refund you the price of the course. So there's even a mechanism for you to get the money that you've invested in the course, get that back. And if by lunch on the first day, if you're not 100% satisfied, if you say, you know what, Victor, this isn't for me, then at lunchtime, just tell me, that you want to disengage, and we'll give you a complete refund, no questions asked. Let's go to the homework. This is a very important step. I want you to come to the workshop prepared. So if you are coming to the webinar from Canada or Ontario, your homework is to go to the Ontario Securities Commission website. And you have 3 things that you need to go find. You need to find out the rules as to what constitutes a security. What is the definition of a security as far as the Ontario Securities Commission is concerned? That's number 1. Number 2, what is the definition of an accredited investor? And number 3, what are the laws against solicitation? I know that information's out there. I've come across it myself. And rather than just handing you the information, I'm doing it deliberately this way because I want you to get in the mindset that when you don't know something, you go research it. Life as a real estate investor is a scavenger hunt. You don't have to invent anything new. The information is out there. You just got to go find it. And I promise you, this is not going to take you hours and hours and hours to find, but these are very important questions that you, as a real estate investor, and in particular someone who's going to be raising capital, need to know. If you are dialing in from the U.S., then I want you to go to the Securities and Exchange Commission website, and you have 4 pieces of homework. You've got to find out what are the rules against solicitation. There is something called the Howey test. Howey was a precedent-setting case. It went to the Supreme Court of the United States. And so the Howey test is a test of what constitutes a security against the legal precedent of that case. There is the SEC definition of accredited investor. And then lastly, I want you to go look up Regulation D and find out what is a Reg D 506 fund. So I will email everyone who registered for the webinar, I will email you separately the homework. So if you didn't get a chance to write this down quickly enough, you will get this by email. Okay? At the course itself, I'm also going to give you a copy of a book called The Speed of Trust. I remember earlier we talked about the psychological contract of trust and how important that is. This book was written by Stephen M.R. Covey, and this is the son of the famous Stephen Covey, who wrote The 7 Habits of Highly Effective People and many, many other books. This was his son, and it's probably the best book I've ever come across. And I know this is a bold statement. I guarantee if you read this book and you internalize it, this book will change your life. And I mean that improve things for you business-wise. It'll even affect your personal life. It'll affect your relationships with family members, with your spouse. Understanding deeply the psychological contract of trust will change your life. I guarantee that. So that's a reading that if you want to get the book in advance, let me know. But if you don't, I'll give you a copy at the workshop. If you're interested in advanced reading, I would recommend a book called Pitch Anything by Oren Klaff. And this is how really to hold a peer-level conversation with people who are significantly above you, people who have wealth, status, position, ego, and power. I'm sure you've all encountered the situation where you walk into an office and you're met by the secretary who their job is to run interference and maintain a barrier between you and the person you're trying to reach. That's part of the power positioning that people with wealth, power, and ego want to maintain so that they maintain that imbalance in a negotiation. This book will teach you how to equalize and level that playing field. And when you have that level playing field, you can have a peer-level conversation with the person across the table and negotiate virtually anything. A couple of pieces of homework. You've got some reading coming up after the course, and for those who are super keen and really want to excel, some advanced reading. If you haven't registered for the workshop, you can do so at greatcanadiantakeover.com/workshops. You can reach me at victor@greatcanadiantakeover.com. And the registration pages for Toronto and Austin are not yet on the website, at least not as of the publication date of this webinar, but they will be shortly. So if they are not up and you are interested in attending either in Toronto or Austin, send me an email, let me know that you're interested, and I'll at least pencil you in and let you know when the registration page is up on the website. And that brings me to the close of the formal part of the presentation. Let me open it up to questions. We'll spend a few minutes on questions. Who would like to go first?
Hi, Victor. I'll go first.
Sure.
You mentioned during the presentation that there's a possibility of you or your team, you and your team, whatever, partnering up on a project. What types of projects would you even be interested in doing that with?
That's a great question. What kind of projects? I mean, typically we look for projects that follow the same criteria that I talked about. So if for example, if you have a great opportunity, it could be in Toronto, it could be in Chicago, in a place where we would be interested in investing, but you've got the deal and you haven't figured out necessarily how to raise the capital, it might be a potential for us to work together. Or if you have 80% of what you need, but you're missing one element, maybe we may be able to put together the remaining 20%. One of the things that we typically find is that deals are everywhere. And a lot of rookie investors tend to focus on just finding deals because they think that's the scarce item, and it isn't. Deals truly are everywhere. And the test for me is that a great deal badly managed is no deal, of course. That makes perfect sense. So it all comes down to the management, and putting together the right team in that geographic location is the critical item. So if you have a deal but no team, and maybe we have a team, there might be an opportunity to work together. If you have a team and a deal but no money, maybe we can work together. There's a few variations on that theme that could work.
Is there a particular size of deal that you'd be more interested in? I'm sure we're not looking at a single-family home. We're looking at something more substantial.
We started out doing single-family homes, and we don't do very many of them anymore. And that's for the simple reason that they're almost the same amount of work as a 10-unit apartment building. So if I had the choice between doing a single-family home or a 10-unit apartment building, I'll pick the 10-unit building all day long. Single-family homes as income properties tend to not generate a lot of residual cash flow. So they typically fall in the category of a buy, fix, and sell transaction. Sometimes they make sense, and we do some flips. We just don't do very many of them. If it's a great opportunity, we'll look at it. There's opportunities in Toronto where the values are higher. Cost of construction in Toronto is no higher than anywhere else, but the values are so high that it can often make an awful lot of sense. Because a 2x4 costs exactly the same. Doesn't matter where you buy it from or where you put it, but it's valued differently depending on where you put it. So we tend to focus more on higher value markets. I think there are some very good opportunities, in particular where there are shortages of a particular product type. And right now in Toronto, there's an extreme shortage of single-family homes and townhouses, and there's a huge surplus of condominiums.
Okay, thank you for that answer. I'm actually going to focus on my investing in the U.S.
Okay.
I'm partnered up right now on three single-family home rentals in Pennsylvania.
Okay.
And I was in Florida. I just got back from Florida, and I found some terrific opportunities for inventory and product. So I'm beginning to buy some single-family homes there. But ultimately... What
community?
I'm in Tampa.
In Tampa? Okay.
Yeah.
It turns out I have a team in Tampa.
Interesting.
And I've probably done 5 or 6 projects in Tampa, mostly waterfront properties. We tend to like waterfront properties, again, for the same reason that we talked about. They tend to be higher value. So if you can buy a decrepit waterfront property and turn it into a stunning waterfront property, you can generate a lot of value. So
I'm sorry, I just actually passed on a waterfront property, canal, golf access, boat docks, in-ground pool, lanai. It was a flip, basically, okay. And I passed it because I couldn't come up with the funding quick enough. But I have others in the pipeline coming up, so that's why I was curious about what type of projects you'd be interested in partnering with.
My typical rule when it comes to single-family homes and flips in particular is I'm looking to make a minimum 30% net profit margin. So that means if I sell a property for $100, then I want my all-in investment, including all the transaction costs, to be at 70. And so then if you back up from there, what that means is that I'm usually buying the property at 40% of the after repair value. So we typically go for a pretty steep discount in order to achieve those types of numbers. I don't like to do thin deals. They're risky, and the risk of losing money is high because you don't control the sales cycle. And in the U.S. markets in particular, valuations vary widely block by block. So, you get a lot of realtors that will give you a comparable analysis based on a 1 mile radius, well, you've spanned 3 neighborhoods. I mean, those are not comps at all. You really want to be looking at comps literally on the same block. And if you get much further than that, they've really got to be right on the same block. If the comps aren't on the same block, it gets really challenging. You got to know the area extremely well. You've got to have some very good feet on the street that know the area extremely well. But yeah, we can certainly talk about that some more. Like I said, we know the Tampa market. Tampa, St. Petersburg, Clearwater, Sarasota, we know those markets really well. Dunedin, there's many, many different markets that we know there.
Perfect. Well, I'll be seeing you at the workshop, so we can talk about it then, if not even earlier.
Sure. Who else has a question? Any other questions?
Well, okay, I guess I'm the only one talking tonight. This is just a little, not quite on topic of real estate, but for the workshop. Yes. Being held at St. Paul University, is there a specific room number? And what arrangements do we make for lunch, given that they're full-day workshops? Should we bring our own, or is there a place to go?
It is a full-day workshop. The cafeteria at the university is closed. There is a wonderful restaurant literally across the street called the Green Door. It's a vegetarian restaurant, kind of cafeteria style. It's very quick. The quality of the food is fabulous. So I expect most people will probably end up going there. We'll end up reserving some space so that we can get in and out of there quickly. It does get busy on the weekends because it's a very popular place. But I just don't remember the room number offhand. You'll definitely get emails over the course of the next couple of weeks with that information.
Okay, perfect. Thank you.
Okay.
You said vegetarian?
It is vegetarian, yes. And there's a couple of other restaurants also within a block of the university. That's the one that I know the best because my wife and I go there on Sunday mornings for brunch very frequently. But
Victor, following to the seminar itself, will you be handing out some materials printed out, or do we need to print anything, just logistics of that?
I'm glad you asked that. If you have an electronic device like a PDA or a laptop or a smartphone, please bring it to the workshop. There will be some online research that you will need to do in the workshop. So if you can bring an electronic device, do so. It's not absolutely mandatory that everybody does. We will be breaking people up into groups to do some of that work. And then the other thing that you need to bring, this is actually very important, and this will also be coming out by email. If you own a game of dominoes, please bring it. There will be a particular group exercise that involves dominoes. So if you have a domino set at home, please bring it.
Okay. Interesting.
Okay.
Okay, thanks.
Hey, Victor, it's Brian. I have a quick question.
Yes. We've been looking into whether there will be Wi-Fi. I believe the answer is yes. If not, we will set up a Wi-Fi access point independently of the university. So one way or the other, there will be internet access.
Okay, perfect.
Okay.
Victor, I got a question.
Yes.
I have to leave Saturday at 4 p.m. Will that disrupt the meeting or anything like that? Or
I don't think so. I got your email. I know you've got a special situation. So, yeah, that'll be fine. I'll catch you up on Sunday morning on what you missed. You may miss one of the exercises, but I think it's one that you could probably do independently.
Fair enough. Thank you.
Okay. Any other questions?
I guess I have one more.
Sure.
If you're, well, in my case, I've been doing single-family homes.
Yes.
But I'd like to scale up as quickly as possible. I'd like to get into apartment buildings. What would you recommend that I even start looking at as far as deals go, like size of deals, number of units? How quickly do you move up?
There's a few increments that you can move up. And, this is one of the things we'll actually be talking about in the course, is how to scale. We'll probably spend about 30 minutes on that topic. Rather than answering it now, I'm pretty confident that that'll get answered in the course.
Okay, that's fine. Thank you.
Okay. Any other questions? Okay, well, if there aren't any other questions, thank you everyone for attending. Look forward to seeing you on the 27th of March or at a later time in Toronto or Austin. Have a great evening, everyone, and look forward to talking to you soon.
Thanks, Victor.
All right.
Thanks.
You're welcome. All right. Bye for now.